Okay, after learning how to pick out those good levels, now we can take a look at a bit of who's in control, the bears or the bulls, which will later bring us into the market structure. Now, we understand where the good levels to buy and sell levels to sell are. And we understand that we need to work on multiple time frames so we can get the strong levels and work backwards into the smaller time frame so we can make sharp entries with a tight stop loss. And now we're on the bears or bulls, who is in control of the market, basically meaning the direction of the market. So the direction will change when market structure changes. So like I said, this brings us into the market structure. And if we understand demand and supply levels so far, if we understand support and resistance levels so far, then now we can get into understanding how trends begin to change. So let's go a little bit more forward. Now, as you know, the market can go in three directions. It's either going to go up, down, or sideways. There is no other direction to go to. And a lot of the times people will be saying the trend is going up or down, depending on, making higher highs and higher lows. Obviously, the market doesn't move like this. It's not very realistic, but just to get our heads around it. At the GlobalTrader.Club in the trader program, I teach this level, but I'm really not a fan of this because we like to calculate where the market is going and where it's going to turn around before it turns around. Because if I start to wait for market structure to change, I have to wait for higher highs and higher lows, and that already is missing out a lot of the trade. Okay, so we don't want to miss out the big waves and enter the trades late. What we'd like to do is basically enter where we can. But for the sake of this course, which is demand and supply, what we want to know is where that trend, where that direction is going to hint to us a change. So as the market goes up, or it could be the other way down, as it comes down, what we want to look out for is a break of a support level, which is pretty much what I showed you in some of the examples before. As the market is going up, we're making higher highs and higher lows, but sooner or later the market is bound to turn around and go the other way, and this is called a downtrend. So we have an uptrend, a downtrend, and normally this zone here will be like a sideways trend, sideways market before the market begins to turn. So market structure should hint to us when the market is going to turn around, and that first hint is, if it's going to start to go down, is when that major swing level support is broken. The market must close below that line. It has to close below that level. And when it retraces up, you're looking to sell. And as it now starts to make a lower low, lower high, you're waiting for it to come to a level where you can spot a supply zone so you can sell off again. And then you're targeting the lows or the breakouts, or even lower with respect to what happened in the past. Okay, so that's the kind of a setup we're kind of looking for in this market structural shape. Like I said, it's not very realistic because the market really doesn't do this all the time. So this is why at the GlobalTrader.Club, in the complete trader program, we have like 4 or 5 different ways of looking at the market, not just demand and supply, because demand and supply will not work all the time. All right, but let's move forward and see what's going on here. Now here's an explanation as to the market going up, down, and sideways. So if the market is making a trend and every time it breaks out, the market is moving towards the next upcoming level, which is going to be a support or a supply or demand, or actually resistance. or support, or new highs and lows. So if you take a look at here, the purple circles are there. Okay, so we have a high here, the market goes up, it retraces, we have the high, it breaks out, and look, that's the goodbye kiss zone I talked about before with the Nasdaq example I showed you with the swing days as well. Okay, so as you can see, the market does that often, and we just have to look out for it. And then every time it retraces back, it gives an opportunity to enter the trade. This is why we like to buy cheap, okay, when the market comes back in an upwards trend. So this is the goodbye kiss zone. Market breaks out, goodbye kiss, going up. Market breaks out, goodbye kiss, going up, and sooner or later it's going to turn around. So we have the up wave here, as you can see, green, and then this is the change happening here, and then this is the downwards trend continuing in red. Okay, and a trend reversal happens when the structure is broken, and that structure, like I said, you have to figure it out. The last high must fall and break that main swing on your time frame. Okay, and that's what's going to give you the signal that the market may be changing. Why is that important? Because when it breaks down and closes below that, it means the market is happy with a lower price. This is why opening prices, closing prices are very important if you're day trading. I don't see a lot of people using it or talking about it, but they actually are very important, because that's a level where the market likes to come and retest and you know, sell off again or buy at again as well, quite often. And then once the market breaks structure, it changes character and retraces back. Once the retracement is done, if the market breaks the new structure, then a flip occurs. A flip means a trend change is confirmed with the second break of structure. So what happens is, the first break is a change of character, the second is the flip. So now you got break of structure, and then any upwards move is a fair game to sell. Now there are too many confirmations here, which is, for me, is late trading. I don't like to enter the trades late as far as here, because we just missed out on all of those. Okay, however though, for the benefit of demand and supply, you have to wait for some kind of a breakout and then a retracement to kind of understand there's a change in the market. Okay, which is fair enough. And you know, if people find it easy to trade that way, it's all good. I'm not saying it's wrong at all, but for me, you know, if I'm thinking about it, if these are the highs and I waited for this and then I waited again to see, okay, now I've got a confirmation, now I'm going to sell up here somewhere, it's like I've missed a lot along the way. Okay, but this is how market structure works, demand and supply works. So we're going to go with those principles as here. Okay, so before we go any further, now that we know what these breakouts is and how to enter these retracements, let's do some examples together. Now while doing these, I do like to also bring a few things together, but what I'm going to do is I'm going to leave these out for the moment, and we're going to come back to these. Okay, so I'm going to leave this end, and we're just going to focus on some examples as to what's going on in this structure. So let's get back onto the charts here, open it up, and let's just get rid of these. In fact, if I just do template 1, we should all be back, and let me go back into the daily, and this is it. So here's a nice structure for us. Okay, so this is actually not a bad example. So let's do this. Okay, so this is SP 500. Now if I go a little bit more down, you can see here it's been like going up and up and up. Let's start from here, for example. Okay, now when the market started here, it made a low. Okay, now the first peak here is this one, as you can see. That's the first resistance that the market broke. In fact, let's do this. Let's take a decent pen and let's see here. That's your low there, okay? And this is the first resistance. Now, as you can see, the market broke and closed above it. So here for us, this is a sign that the market is changing character, okay? Because we just broke above this last swing, closed above it. And then the market retraces back. Now, where does it retrace back into? Let's make this a little bigger. I'm just going to put this here so we don't lose it. But if I make it a little bigger, it'll make sense. Okay, so let's do that. And this is the zone. All right, so we broke out, and this is the low where the market broke out of. Okay, so it's all good. Once we break out of this first resistance, that's change of character. Now the market comes back. Look at the bar it comes back into. It comes back into that last red bar where the market broke out above that resistance level. So that's your kill zone. Now all you have to do when the market breaks out above there is wait for the market to come back into here. All right, so that's how it is. And then what do we have? Well, then we have another breakout. Now the market broke above this, and now we've closed above that. So now we're thinking, well, now we've got a break of structure, okay? Because now we've got highs and lower highs, sorry, higher lows, my apologies, higher lows, and now I've got higher highs, okay? And now we're thinking, okay, now higher highs, higher lows happening. We're in a bullish kind of move. Now what you have to be careful here is this. This is your next resistance level. So this is now a target. But if you're taking an up target like that, my sincere recommendation is to make sure you target the closing price when you're targeting something, okay? Because the wicks won't always get hit, but the closing price they like to touch. So if you keep that in mind, you'll be safe. And remember, this is a place where they sold heavy, so when the market comes into this bar, you should already be like, awake, okay? But I'm going to get rid of that now just for the sake of argument. That was like a side note. Let's do that. So now we've got higher highs and higher lows happening. And the bar that caused the breakout of this resistance is this little red bar here. Well, it's not a small red bar, but it's a big red bar because the day of falling that caused it. So I want to mark it in again. So I'm taking that zone, that full candle, and that's basically what I'm doing. So now I'm thinking, okay, now this bar is going to be the buy zone. As you can see, the market's been in here. It's been touched so many times. This is a zone. It's a battle zone. All right. So you see how many times the market going up, down, up, down, up, down, up, down. But it is not going below that. Hasn't broken it. And then finally it takes off again. Okay. And that's how the whole thing starts. Now, as you can see here, this is the zone, right? And now it's broken above, it's closed above it. So now it's pulling back to go back up. So now I have to say to myself, what caused this to break? Okay, so what are those bars? Well, there's one here. Let's take a look. So this is one bar. Now with this one, you've got a blue wick. So you want to take that wick and you take the blue bar into consideration. Okay, So that's one zone. All right. This is a big red zone. This is a big one here where you got a breakout. And if you think about it, this red bar caused a break of this resistance. So that's a zone as well. All right. So that's how the market's going. And then you got heavy buying coming in here, which broke that resistance there. Okay. And what caused that breakout is this red bar here. So then this red bar becomes your zone. Okay, so now you got a bunch of zones happening here. Now don't panic because you've got tens and tens of zones happening here. The important thing here to understand is once we have a move up, you can see, okay, the market is breaking and making higher highs, higher lows. This is on the daily. Okay, now let's get rid of everything. And if I was to break this down into the weekly, now look at what's going on. Let's delete all of that and all of that. Now let's take a look. As you can see now, this is the first resistance, isn't it? There you go. Now the market breaks out, but hasn't really closed above it. Okay, it's been mucking around with it, going above it and so on, but it hasn't really closed above it. Still though, the market buys when it hits that manipulation bar. If I make this a little bigger, let's do this so we'll see better. All right, so that's it. As you can see, the market goes up, comes back down, slightly higher, nothing hefty, but this is actually where the market takes off. Okay, the market still did come back into this bar, and that's the manipulation. Why? Because it pulled back. Now remember, I said I didn't want to touch the topic of Fibonacci retracements, gaps, pivots yet. Okay, however, this is worth mentioning here. Once the market has, made a significant push, it came back and made kind of higher high. Normally, we're checking this high to be broken, but in the technical analysis complete trader program, that's not the only thing I'm really looking at, because we're also looking at a breakout of that. Okay, so despite the fact here the market hasn't broken out, I've broken out of here and I've come back into a goodbye kiss where the market actually has a manipulation bar going up. Okay, I hope that makes sense a little bit. This is why, just the demand and supply on its own, I don't think it's sufficient, but just for the benefit of this course, this mini course, you can enter it in there again. So that's the weekly. Now if I extend this, if I just get rid of those, what I'm going to do is I'm going to do this. Okay, and then I'm going to turn this into a daily. Okay, this is where we'll find ourselves at. So as you can see now, that level has become much cleaner for us as an entry level. Okay, I hope that kind of like helps you out in understanding. When you're looking at the daily, in any case, you're going to have to look for where the breakout happened, and that's going to be the highs here. If you want to keep it simple, you can do it this way, not a problem. Okay, once you have a breakout, just look at the red bar, the last red bar, which started the big push and caused the breakout, and that's going to be your place to get in. Sometimes you can also draw trend lines. Okay, may not always work, but sometimes they do work. I use them actually. Okay, but that's how it is. For the benefit of this exercise though, we're going to have to just look for the breakouts to determine that we're going the other way. And the bigger the time frame, obviously the stronger. So in the weekly, when you see something like this, you can turn this into a daily, and then you know this is your kill zone. And once the market starts, it's just going to do what it needs to do and push up. Every time the market breaks above a level, then you're going to understand that, you know, once we break out, the pullback, and it's going to go on. Same thing for any level. It will do a pullback after it breaks out, even here. Okay, market's gone. Here, look, they just buy again. Why? Because that's the last manipulation. Okay. If you keep adding your levels as the markets move, your future entry levels, your future targets will already be on your chart. Okay, so the market comes in, you're a buyer. Market comes in, you're a buyer. Market broke out. That's it. You lost money, you got stopped out. It's doable. Okay, it happens. Then you're going to have to look for another setup entry. Okay, sometimes you will get stopped out. There is no overcoming that. The same thing here on the other side. As you can see, the market makes a double top here. All right, pretty much a double top, and crashes. Now look what happened. This is the main swing. Okay, why? Because from here we made a higher high. Okay, this is a swing as well. We made a higher high. So this level, as you can see, broke. All right. Once this level broke, closed under it, that's it. The market just kept pushing down. Now look what caused the breakout of this bar. Okay, the breakout of this support is caused by this. So if the market comes back up, this is going to be a sell zone to push down. Okay, so all these levels we want to be looking into. All right, so this bar is important, obviously. Okay, and if you watched last week's videos when I did this is March, you know, you would have known that this was also a swing day and falling down into Friday, and today is Monday. Okay, so all of these are pretty much self-explanatory. If you measure that move, then you can get back in. Now let's also evaluate things from a Fibonacci point of view. Once a market breaks out, okay, let's get back here to where we started. Okay, once a market breaks out, the low point of where the market took off can be your measuring tool. So that's your base, that's the high it did, wick to wick, and then you can bring it back into a Fibonacci level. I'm just going to change the colors on that into something a bit more forgiving to the eyes. Let's do magenta. All right, here we are. Now look where we're at. We're at 23. Now normally I've got 37.5, and I like to use 25 for the benefit of this exercise. I'll use 25, and you'll sometimes see me use 12.5 as well. You can add them in to your Fibonacci levels, not a problem. Okay, so that's your 25 zone, as you can see. So market comes back into the 25 and takes off. Now what you have to match here is the swing day. So did we have a swing day on the 3rd of November 2022 and or the 4th of November 2022? Okay, so that's what you need to check when we're doing it. All right, so obviously and then you can kind of like go in, but that's the structure. Then you got higher highs, higher lows, and in the bigger time frame. Now if we turn this into a weekly, you're going to do the same thing. You're going to do the same thing with your weekly. It's just going to be the same kind of setup. Let's bring this all the way down here. It will be the same kind of setup, but on the weekly. So let me get rid of that. Let's get rid of this. That's your weekly. Okay, so that's your weekly push, right? So now you take your Fibonacci, you put it to the high, you put it to the low. Okay, and that's your 37.5 zone there, and that's just between 50 and 37.5 zone there. Okay, so basically it's still the same kind of zone. So you're in that zone now, and the market takes off again, comes back, same level, taking off again. So you can match a Fibonacci level. This is why I use Fibonacci quite often, with your demand zone or your supply zone. If you're selling, your demand zone, match it to a swing day, match it to a swing hour, and just go with it. Okay, and that's just how practical and easy it is. All right, so let's get rid of those, and it's the same thing. Okay, so we're just doing basically the same kind of mentality here. Once the market breaks above here, normally I'd like to see it closing. Once it breaks above, then closes above, you can see it's a change of structure. So the market comes back, and we just want to go up with it. Okay, once again, the place it comes back to, that manipulation bar, nice and easy, that's the zone, and you can go up as well. You can do this on a weekly, daily, 4 hour, like I said, whatever you like. But as we get into that, you can do it on a weekly. When you get in there, just move it into the daily, the 4 hour, and like sharpen it up a little bit so you don't have a big stop loss. Okay, and that's exactly the same kind of thing we'll be doing with anything and everything. Let's check out, for example, the euro dollar, which we were following for ages. And in fact, once it was down here, I was saying, okay, we've got to buy, because this matched. Let's take a look at the monthly. Okay, because this matched our Fibonacci. Okay, so that's the high, that's the low, and that's your 37.5. It matches swing days. It matched, that's it, basically. Turn that into a daily. Let's take it to the end. That's your 37.5, you see. Once the market breaks out, goes above that first high, you see, this is where the market goes up. It breaks above that first high there, closes above it, pulls back, nearly a double bottom. If I was to get rid of those, let's put a Fibonacci on. We're either going to be 25 or 12.5. That's your high, that's your low, and that'll be your 12.5 there. Okay, market picks up and starts pushing up. You could do the same thing again and again and again. All right, basically it. So now we have, again, look, we have an opportunity here too if you're trading euro dollar. So that's the high now. So we should have a market coming back down here, shouldn't we? And when it does, what is the manipulation bar? What are we going to be looking out for? We're going to be looking out for this little bar here. So if I was now looking out for the euro dollar, and if you're following my videos, you would see a rectangle right there, because this is exactly what I'm doing. What I'm showing you is what I am doing, and that's what you can see in the videos as well. The market should come back down. I'm going to tighten this up a little bit for the benefit of this exercise. Now that we understand we're going up, because if we get tight like this, you see now, okay, we're up move, market comes back 37.5, is going back up, and now as we pull back, we just want to be bullish, okay? So we're kind of like following this move here. All right, now look what happened on the way down. This is the daily chart, and see how big this is, like from 2022. Okay, once the market on the smaller time day, on the daily, look how it turns around. This is your double top here, and this is your, let's say, sell-off here. I'm going to make this a little bigger just to show you that change in mentality. All right, let's get rid of these. Now going to the downside, the same thing. That's your support. Market breaks down. Okay, what causes the breakdown is that blue bar there. Okay, that's the major swing, and then it breaks down. Now the sentiment is to the downside, so they're pushing it down all the way, all the way, all the way. And now I've got a low, break, a higher high, higher low, higher low, higher low, big higher high. So when the market pulls back, we want to go up. Okay, so this is how the structure happens. This is why we're looking out for these breakout levels every time. Since in this example here, that's a big push down. Okay, and if I was to re-enter the euro dollar, as you can see, it didn't come back a lot. It didn't come back much at all. They just sold it straight off. If I take the peak at 61.8. Okay, so that was actually the level where they just sold off. So that was pretty bearish. Okay, they didn't give it any opportunity to pull back, but as soon as it came back down to the 37.5 on the monthly, they started buying. So if we know these levels, you can match it to your swing days. If you know that you have a swing day here on the 6th of November or the 5th of November here, then you can say, you know what, I'm going to sell the 61.8 because I've got a swing day here. Also, you can match it to any manipulation bar. If you think about it, where's the last swing, right? So the last swing is, there's one there and there's one there, right? So the market breaks down. What causes the break of that support? It's this bar here. This is the daily, remember? Okay, as you can see, it causes the break, market comes back and just sells off again, and it matches the big 61.8, 61.8. But also, if you hold it from here to here, that's your manipulation bar. If you take it to that one, that's your 25. So it's all ratioed up. Okay, the reason it's good to use multiple tools is, if you mess up with one way of looking at the market, another way of looking at the market will save your neck. Okay, so this is why at the GlobalTrader.Club we're always using multiple different strategies. The same thing you can do for anything you want. Let's take a look at Bitcoin as well. Let's not be lazy. Now look at the market here. Okay, market makes a big push at the end of December, breaks the resistance. Once that resistance is broken, goodbye kiss, market goes off, dips down lower, and then it goes back up again. Why does it dip all the way lower? Let's take a look at the Fibonacci. Now look, the market push is really coming from here. That's the peak, and this is the push with there. All right, the market manipulations, I think it's there. If I make it a little bigger, we'll see which one it is. So there's your red bar there. Okay, there you go. Market makes the high, goes there. The bigger the high, let's go there, and then big push into 37.5. Okay, so market goes up, comes down. Every time we're breaking structure, we need to understand a pullback is in order. All right, and that's how it is. If you took this and you bought on the 61 and this was a swing day, you would have been okay. This is also a manipulation bar zone here. This is the red bar before the big push up. The only tricky situation here is a gap. Okay, I haven't touched at gaps yet, but we will. The important thing here is first understand the break of structure. Once we're breaking structure, what you want to be doing is waiting for the pullback to get back in. Now look, the structure breaks out here. The market's big push coming in here. There's a manipulation bar here. So this is one red bar, which is manipulating. And the big push to there is from here, and that's your 50 zone. So the market is coming into a 50% zone. It's a manipulation bar. You have to check if this is a swing day or not. That is the 14th, and that is the 15th of June 2023. Well, let's check. Let's do it together. June 2023. Where are you? June 2023. Okay, so the 16th of June. Let's see where we're at. Let's load this up. Now, the 16th of June 2023 is 16th of June is a Friday, so we're looking at Thursday, Friday. So the Monday is going to be the 12th. And why do I need to look at the 12th? Because the swing days are on the 12th. Let's take a look at Bitcoin. I've got Tuesday, Friday, Sunday. So Friday is going to be the 16th. All right. Tuesday, that should be why, but Tuesday, Friday, Sunday. So Friday is the 16th. Okay, because that's your Monday. And where are we? Here we are. This is where we are, and that's your 16th. That's your 15th. That's your 16th. All right, so I think we've got it, right? Okay, Bitcoin, Friday, the 16th. And that's when the market takes off. See what a big day that is? Okay, so Friday, Thursday, Wednesday. Okay, and that's basically it. Friday, up and away from your manipulation bar. So, you know, that's basically what we're trying to do, and fitting, you know, the swing days and the swing hours like that into that day as well. Okay, so I hope that's making sense. Also, obviously, on the 16th of of oh, not that one. On the 16th, obviously, of June as well, what you're going to have to look out for is the hours too. All right, so if I go back into June 2000 and was that 23? Yep, 16th of June 2023. So June 2023. Then you got to check the hours as well. As you can see in the current version, I've got the swing days and the swing hours all like kind of on, on one page. Before it was all on separate pages. And then you'd be looking at these hours to buy the lows, okay? Because that's your zone and that's how you want to get in there. Okay, I hope that makes sense. But this is basically it. And we're putting demand and supply to use to measure and match your timing analysis. So the whole idea of learning this demand and supply is obviously so you can match your swing days and your swing hours. Okay. Now what I'd like you to do after this long session is take a break, but you have to go back and check a bunch of breakoff structures. Do it on daily, 4 hour, on a variety of assets. Go in there and say, okay, if I'm trading the pound, even if I'm trading on a smaller time frame, how long do I want to take this up there? Do I want to sell? Whoops. Do I want to sell? So if I see that the market is breaking structure, those are your swing days, right? So this is a 1 hour chart, by the way. You see how the market is breaking structure, okay? It is breaking structure here. So what you want to be looking at now is where can I sell? Where can I sell? Where can I sell? So just do it on a bunch of different assets in different time frames so you can figure out this change in the market. Because once a change starts to happen, that's going to be like your swing day, swing hour, your retracement, and that's it. That's how you're going to trade. So a lot of exercises, try it out on a bunch of stuff, and once you get really competent at it, move on to the next module.